Gold has once again reached a critical turning point, and the next few days could decide whether we see another historic rally or a deeper correction. Right now, gold is holding above the $4,060 per ounce level, but behind this seemingly calm price action, some of the world's biggest financial forces are colliding. On one side, rising geopolitical tensions in the Middle East are increasing demand for safe haven assets. On the other side, the Federal Reserve continues to battle inflation, while bond yields and the US dollar remain powerful obstacles for precious metals. At the same time, central banks are quietly increasing their interest in physical gold, sending a signal that long-term confidence in the metal remains intact. So the big question every investor is asking is simple. Is gold preparing for its next breakout, or is another correction just around the corner? Today, we are going to separate emotion from facts and examine the latest verified macroeconomic data, market signals, and technical levels to understand where gold could be heading next. Over the past several months, gold has experienced one of the strongest rallies in modern history before entering a period of consolidation around the $4,000 to $4,100 range. Many new investors see this sideways movement as weakness, but experienced market participants understand that consolidation often follows a powerful advance. Markets rarely move in a straight line. After a major rally, investors take profits, institutional funds rebalance their portfolios, and traders wait for fresh economic data before committing to new positions. This process allows the market to absorb previous gains while preparing for its next significant move. One of the biggest reasons gold continues attracting attention is the growing level of geopolitical uncertainty. Tensions involving the United States and Iran have kept investors cautious, increasing demand for traditional safe haven assets. Historically, periods of geopolitical instability have supported gold because investors seek assets that are not directly tied to the performance of governments, corporate earnings, or individual currencies. While geopolitical events alone do not determine long-term gold prices, they often provide short-term support whenever uncertainty increases across global financial markets. At the same time, another major driver is the Federal Reserve. Gold does not pay interest or dividends, so its performance is heavily influenced by expectations for U.S. interest rates. When investors believe the Federal Reserve will keep rates higher for longer, Treasury yields usually remain elevated, making interest-bearing assets relatively more attractive than gold. However, if inflation continues to moderate and markets begin expecting future rate cuts, gold often benefits because the opportunity cost of holding the metal declines. This relationship explains why every inflation report, employment release, and Federal Reserve statement immediately affects gold prices. The bond market is also playing a critical role. Treasury yields remain one of the strongest indicators influencing investor behavior. Higher yields generally create short-term pressure on gold because investors can earn better returns from government bonds. However, if bond investors begin worrying about slower economic growth, expanding fiscal deficits, or financial instability, demand for gold can increase despite elevated yields. This is why professional investors monitor both treasury yields and real yields rather than focusing on the gold price alone. Another important development comes from central banks. According to recent reports, the Bank of Korea is preparing its first physical gold purchase since 2013. Although the initial purchase may not dramatically change global supply and demand, the decision itself is significant. Central banks are among the largest long-term holders of gold, and when they increase their reserves, it reflects confidence in gold's role as a strategic reserve asset. Over the past several years, central banks around the world have steadily accumulated gold as part of their reserve diversification strategy, reducing dependence on foreign currencies while strengthening financial resilience. As we move deeper into this analysis, another important question begins to emerge. If geopolitical risks remain elevated, central banks continue buying gold, and inflation has not completely disappeared, why has gold struggled to break decisively above recent highs? The answer lies in the powerful tug-of-war between safe haven demand, Federal Reserve policy, treasury yields, and the US dollar. Understanding that battle is the key to identifying gold's next major move, and the latest economic data may provide the first clues about which side is starting to gain the upper hand. As we step back and look at the bigger picture, one thing becomes very clear. Gold is no longer being driven by a single event or one economic report. Instead, it is reacting to a combination of global macroeconomic forces that are all moving at the same time. Institutional investors, hedge funds, central banks, and sovereign wealth funds are not making decisions based on headlines alone. They are watching inflation trends, Federal Reserve policy, treasury yields, currency markets, geopolitical risks, and global liquidity. When all of these factors begin pointing in different directions, the result is exactly what we are seeing today, a market that remains volatile but refuses to abandon its long-term bullish foundation. One of the strongest long-term pillars supporting gold continues to be central bank demand. During the past several years, central banks have consistently increased their gold reserves as part of a broader strategy to diversify away from excessive dependence on foreign currencies. This trend reflects a growing desire to strengthen national reserves with assets that carry no credit risk. The latest reports that the Bank of Korea is preparing to purchase physical gold for the first time since 2013 have once again reminded investors that official sector demand remains active. While one central bank purchase alone will not dramatically change global prices, the broader message is important. Central banks typically invest with a long-term perspective, and their actions often reinforce confidence in gold as a strategic reserve asset rather than a short-term speculative investment. At the same time, institutional money flows are becoming increasingly important. Large investment funds continuously adjust their exposure to precious metals based on changes in inflation expectations, interest rates, and portfolio risk. During periods of financial uncertainty, many institutional investors increase allocations to defensive assets such as gold. However, when risk appetite improves and equity markets rally strongly, some of that capital naturally rotates into higher risk assets. This constant movement of institutional money explains why gold can experience periods of consolidation even when the long-term macroeconomic outlook remains constructive. Another factor that deserves close attention is the relationship between gold and real interest rates. Many investors focus only on nominal treasury yields, but professional macro analysts pay much closer attention to real yields, which represent interest rates after adjusting for inflation. Historically, gold has performed best when real yields decline because the opportunity cost of holding a non-yielding asset becomes lower. If inflation remains relatively elevated while nominal yields stabilize or begin falling, real yields could gradually move lower, creating a more supportive environment for gold over the medium term. This is one of the reasons many long-term investors remain optimistic despite the recent period of sideways price action. Silver, however, faces a slightly different challenge. According to several market analysts, including recent commentary from international brokerage firms, silver's industrial outlook has softened compared with earlier expectations. Industrial demand remains an essential part of silver's value because the metal is widely used in solar panels, electronics, semiconductors, medical equipment, and advanced manufacturing. If global manufacturing activity slows, silver may face periods of underperformance relative to gold. However, history has repeatedly shown that once industrial demand begins recovering and investment demand remains strong, silver can experience significantly larger percentage gains than gold due to its smaller market size and higher volatility. Another element influencing precious metals is global monetary policy beyond the United States. While the Federal Reserve remains the most influential central bank, decisions by the European Central Bank, the Bank of England, the Bank of Japan, and other major monetary authorities also affect global liquidity and currency movements. If several major central banks eventually move toward easier monetary policy while inflation continues moderating, liquidity conditions could improve across financial markets. Historically, environments with expanding liquidity have often provided favorable conditions for precious metals, although the timing of those moves is never guaranteed. When all of these macroeconomic pieces are connected, the picture becomes much clearer. Gold is currently trading in a market driven by patience rather than panic. Investors are waiting for confirmation that inflation is moving sustainably lower, that the Federal Reserve is approaching a policy shift, and that economic growth is slowing enough to reduce upward pressure on interest rates without triggering a severe recession. Until those answers become clearer, gold is likely to remain highly sensitive to every major economic release. And that brings us to the most important stage of this analysis, because the next few weeks could determine whether gold breaks into another historic rally or extends its consolidation before the next long-term move begins. Part 4. The next few weeks may become one of the most important periods for the precious metals market this year because several major economic events are likely to shape investor expectations at the same time. Inflation data, labor market reports, Federal Reserve communication, Treasury auctions, and geopolitical developments are all arriving within a relatively short window. Any one of these events could trigger short-term volatility, but together they will determine whether gold remains trapped inside its current trading range or begins its next major trend. This is why professional investors avoid making decisions based on a single headline. Instead, they wait for multiple pieces of evidence to confirm whether the macroeconomic environment is genuinely changing. One of the biggest questions revolves around the Federal Reserve's next move. If upcoming inflation reports continue showing gradual improvement while employment begins to soften, policymakers may gain confidence that restrictive monetary policy has achieved its objective. In that scenario, markets could begin pricing in future interest rate cuts, reducing Treasury yields and weakening the US dollar. Historically, those conditions have provided a supportive backdrop for gold because lower real interest rates reduce the opportunity cost of holding a non-yielding asset. However, if inflation remains stubborn or the labor market continues surprising to the upside, the Federal Reserve may maintain a cautious stance for longer. That would likely keep financial conditions tight and could temporarily limit gold's upside momentum. The US dollar will remain another critical variable. A stronger dollar generally creates short-term pressure on precious metals because gold becomes more expensive for international buyers. But currency markets rarely move in isolation. The dollar is influenced by interest rate differentials, global capital flows, economic growth expectations, and geopolitical uncertainty. If investors continue viewing the United States as the safest destination during periods of global instability, demand for dollar-denominated assets may remain elevated. On the other hand, if confidence shifts toward expectations of easier monetary policy or improving global growth outside the United States, the dollar could gradually weaken, creating a more favorable environment for gold and silver. Another development worth watching is investor positioning. After gold's remarkable rally earlier this year, many institutional investors locked in profits and reduced short-term exposure, contributing to the current consolidation. That does not necessarily indicate a bearish market. In fact, strong bull markets often experience healthy periods of consolidation as excessive speculation is removed and stronger long-term investors gradually accumulate positions. If new macroeconomic catalysts emerge, institutional capital could once again flow back into precious metals, providing fresh momentum for the next leg higher. Geopolitical uncertainty also remains an important pillar supporting the gold market. Ongoing tensions in the Middle East, uncertainty surrounding global trade, and increasing strategic competition between major economies continue reminding investors that geopolitical risks have not disappeared. Gold has historically served as a store of value during periods of uncertainty because it carries no default risk and has maintained its purchasing power across multiple economic cycles. While geopolitical events can create sudden price spikes, their long-term impact usually depends on whether they significantly alter inflation expectations, energy prices, or global financial stability. Silver deserves equal attention because its outlook may improve rapidly if manufacturing activity stabilizes and investment demand strengthens simultaneously. Unlike gold, silver benefits not only from safe haven buying, but also from industrial consumption in sectors such as renewable energy, electronics, electric vehicles, and advanced technology. If global industrial production accelerates while monetary policy gradually becomes more supportive, silver could experience stronger percentage gains than gold. However, it is also important to remember that silver is historically more volatile, meaning both upward and downward price movements can be much larger over shorter periods. When all these signals are viewed together, the current market does not appear to be signaling the end of gold's long-term story. Instead, it appears to be moving through a period of adjustment where investors are waiting for greater clarity before committing significant new capital. The next inflation reports, labor market releases, central bank decisions, and geopolitical developments will likely determine whether gold breaks decisively above resistance or spends additional time building a stronger foundation. In the final part, we will connect all of these macroeconomic signals into a practical outlook for investors, discuss the most realistic scenarios for gold and silver over the coming months, and explain why disciplined risk management may become just as important as choosing the right direction. Part 5. The biggest mistake investors can make right now is believing that gold will move in only one direction. Financial markets rarely reward certainty, especially during periods when inflation, interest rates, geopolitics, and economic growth are all changing at the same time. The reality is that gold is sitting at the intersection of multiple powerful macroeconomic forces. Every new inflation report, every employment release, every Federal Reserve statement, and every geopolitical development has the potential to shift market expectations within hours. That is why disciplined investors focus less on daily price swings and more on the long-term macro trend. Looking ahead, there are 3 realistic scenarios that every gold investor should keep in mind. The first is the bullish scenario. If inflation continues moving lower without a sharp deterioration in economic activity, the Federal Reserve could eventually begin reducing interest rates. Lower real yields, a softer US dollar, and improving investor confidence in precious metals could provide the conditions for gold to challenge previous highs and potentially establish new record levels. Under this scenario, silver could also benefit, especially if industrial demand improves alongside renewed investment flows. The second scenario is a prolonged consolidation. This may be the most realistic outcome if inflation remains above the Federal Reserve's target, while economic growth continues slowing gradually without entering a recession. In this environment, gold may continue trading within a broad range as investors wait for clearer signals from the Federal Reserve and incoming macroeconomic data. Sideways markets often test investor patience, but they also allow institutions to accumulate positions before the next major directional move develops. The third scenario is a deeper correction. If upcoming economic data shows stronger than expected growth, persistent inflation, and a resilient labor market, the Federal Reserve could maintain higher interest rates for longer than markets currently anticipate. Higher Treasury yields and a stronger US dollar could place additional short-term pressure on gold and silver. Even in that scenario, however, a correction would not automatically invalidate the long-term investment case for precious metals. Throughout history, major bull markets have experienced temporary pullbacks before resuming their broader upward trend. For silver investors, the outlook remains closely tied to global manufacturing activity. If industrial production strengthens, demand from sectors such as solar energy, electronics, electric vehicles, and advanced technology could provide an additional source of support. Combined with investment demand, this could allow silver to outperform gold during the later stages of a precious metals bull market. However, if global economic activity weakens further, silver may remain more volatile because of its greater dependence on industrial consumption. The most important lesson from today's market is that no single indicator should be viewed in isolation. Gold is influenced by inflation expectations, real interest rates, treasury yields, central bank policy, currency movements, geopolitical developments, institutional capital flows, and investor sentiment. Professional macro investors build their outlook by combining all of these variables rather than relying on one news headline or one economic report. That approach helps reduce emotional decision-making and allows investors to respond to changing market conditions with greater discipline. As we move through the coming weeks, pay close attention to inflation data, the labor market, Federal Reserve communication, treasury yields, and the direction of the US dollar. These indicators will likely determine whether gold breaks above its current resistance levels or remains in consolidation before its next major move. Regardless of short-term volatility, the precious metals market continues to be one of the most closely watched sectors in global finance because it reflects confidence in monetary policy, fiscal discipline, and the broader economic outlook. If you found this analysis valuable, don't forget to subscribe to Macro Bullion and turn on notifications so you never miss our latest macroeconomic and precious metals updates. Let me know your opinion in the comments. Do you believe gold will break above its recent highs, or do you expect a deeper correction before the next rally begins? I look forward to reading your perspective. DYOR, do your own research. This video is for educational and informational purposes only. It should not be considered financial, investment, or trading advice. The market data, macroeconomic analysis, and price levels discussed are based on publicly available information available at the time of preparation and may change as new economic reports and market conditions develop. Always verify the latest gold and silver prices, Federal Reserve updates, economic data, and geopolitical developments before making any investment decisions. Every investment carries risk, including the potential loss of capital. Conduct your own research, diversify your portfolio where appropriate, and consult a licensed financial advisor if you require personalized investment guidance.